As technical traders, we have a vast array of tools at our disposal. And one of those tools are called oscillators. In this particular chapter, I will take you through what oscillators I use for my own personal trading. Let's talk about momentum and momentum indicators. A momentum indicator records the speed of prices as they are moving over a certain time period. And at the same time, momentum indicators track the strength and the weakness of a trend as it progresses over a given time period. Some of the most popular momentum indicators are the RSI, the MACD, the stochastics, momentum, rate of change, and CCI. What these indicators have in common is that they attempt to measure two things. The first thing they attempt to measure is whether the market is overbought or oversold. And in order to do that, they make use of bands, which theoretically indicates if the asset is overbought or oversold. The second thing that a momentum indicator attempts to measure is a directional divergence between the price itself and the momentum indicator. Now, at this point, I need to make a couple of things clear to you. First of all, I do not believe in the notions that a market is overbought or oversold. I have seen way too many markets stay oversold or overbought for months on end, and it made no difference to the traders in the marketplace. So I have a long time ago stopped placing trades in the market merely because a momentum indicator suggests that a particular market is oversold or overbought. The other thing I need to make clear to you is that all momentum indicators are pretty much the same. Now I know some die-hard technicians will disagree with me on this, but remember, I'm not a technician. I am a trader who uses technical analysis to get into and out of the market. So I make use of what works for me. So I have thrown away all the momentum indicators and I use just one now, which is the stochastics indicator. It works for me and I'm going to teach you how I use it in my trading. But I am still going to show you some of the other momentum indicators and how to interpret them. I never was a big fan of momentum indicators until my trading partner David Paul taught me the same strategy that I'm going to teach you in chapter 12. And when I saw this technique in action, I was hooked, and I think you will be too. It is exceptionally powerful and has a very good track record. But before we can get to that, we need to go through the basics of momentum indicators. All the momentum indicators are, as I said earlier, pretty much the same. They all have the same properties, and the most important aspect of each is referred to as divergence. We will talk a lot more about divergence as this chapter progresses, but right now it is time to introduce to you what a momentum indicator really is. On the chart that you are seeing unfolding on your screen right now, you will see price unfolding, and underneath it you will see the momentum indicator unfolding. And this particular momentum indicator is called the RSI. It spans from 0 to 100. The theory states that once the market becomes oversold, it's time to buy. And once it is overbought, it's time to sell short or get out of a long position. This, in this case, on this chart, is confirmed by a trend line break. As I say when I show people this chart, if only it was that easy. There's no point in keeping you in suspense anymore. I need to get to the point of this chapter, and that is to teach you about divergence and reverse divergence. And once you understand this, you'll be much better equipped to understand and appreciate the trading strategy presented to you in chapter 12. In the chapter on the principles of price action, I stated that momentum precedes price. In other words, if momentum was making new highs, then there was a high probability that price itself would make new highs. The opposite is true as well. If momentum was making new lows, then I would expect price to follow and make new lows too. What divergence means is that one of the two components, i.e. price and the momentum indicator, is diverging from this principle. For example, on the chart you see on the screen right now, price is making new highs before the trend turns down. But while it is making new highs, the momentum indicator used here, called the RSI, is not making new highs. As a matter of fact, the RSI is topping out before the price is topping out, and RSI begins to make lower highs and lower lows. And this is an example of a divergence, and it's a powerful signal to the trader that the current trend may shortly run out of steam and turn. Let's take another example. Repetition is, after all, the mother of all skills. And I need to make sure that you have several examples to refer to so you can start finding the trading setups in the live trading environment. On this chart you can see how price is making a double bottom, but underneath the price you see how the RSI is making a slightly higher bottom. This is another example of a divergence. Price fails to break to new lows. And this bullish action is confirmed by the RSI, which is now making slightly bullish overtures by making a higher low. I think it's important that you keep in mind that what we are looking for is a sign that momentum is indicating a reversal is at hand. But as traders, we still have to take into account that we have to protect ourselves and that we can't simply start buying or selling short indiscriminately just because we have seen a divergence unfold on a chart. When we see a divergence in a market, it is the market's way of telling us that the internal dynamics of the price action may not be as strong or may not be as weak as the price action alone led us believe. However, I still have some tough choices to make. I have to consider where to get into the market if I want to enter into a position. I also have to consider my exit strategy in case the market does not cooperate with my position. I personally will prefer to enter the market on some sort of reversal signal in price itself, but that may not be present. There may be no reversal signal for me to work with, and I have to take those factors into account when I trade. So whether I have a double top or a head or shoulder pattern to work with, or even a triple bottom to work with, and the divergence confirming the potential for a trend reversal, I still have to take all of these factors into account before I place my next trade. Now sometimes this decision is made in a split second, and sometimes I will wait and I'll sit patiently for half an hour or more just waiting for the right moment to strike. You've probably heard this before, but it is so true that it is worth repeating. Trading is really simple. You buy, you sell, or you do nothing. But it isn't always so easy. I was once asked by a family member to describe how I day trade the market. And I told my nephew that being a trader is somewhat akin to being a hunter. You sit patiently and quietly waiting for an opportunity to strike. Once an opportunity presents itself, you check that all the parameters that you can control yourself are in place, and then you are in a position to strike. It doesn't always mean that you are going to be successful. This morning, for example, I was attempting to buy the euro-yen. So I wanted to go long the euro-yen, and I had in mind that I wanted to be a buyer at a certain price level. If it hit this price level, my order to buy the euro-yen would be triggered. But what happened was that the currency pair came within 2 pips of my entry point, and then it reversed back up again, gaining more than 90 pips in the space of the next 10 minutes, but without me in the position. And although that can be somewhat upsetting as it happens, you have a sense of satisfaction when you review the trading day afterwards and you know that you followed your trading plan. Now, we've spoken about divergence now, and I hope that by now you have a pretty good understanding what divergence is all about, but I'm going to have to be honest with you now. Divergence is not my favorite momentum indicator. As a matter of fact, the reason why I'm not overly keen on divergence is because I know there are so many traders looking at it instead. My own trading mentor, David Paul, has taught me a different kind of momentum indicator, which I feel has a much greater impact on my trading, and it's called reverse divergence. A reverse divergence is a momentum indication on par with a normal divergence, but with a slight twist. With normal divergence, we are watching for price to make new highs or new lows, but the momentum indicator, such as the RSI, is not confirming this. The momentum indicator is failing to make new highs or new lows. But with a reverse divergence, the opposite is true. With reverse divergence, price has failed to make new highs or new lows, but the momentum indicator is making new highs or new lows. So while price is making a top, which is slightly lower than the previous top, the momentum indicator is making a new high. On the chart on the screen, you can see an example of that. On the price side of the chart, you can see how the market is making a new high, which is signified by point A. And then it proceeds to make a lower high, which I've signified by point B. But at the same time, the RSI is making a high at point A and a higher high at point B. And that is a reverse divergence setup. And like the normal divergence, it's an indication to you as a trader that the market may be running out of steam and that a reversal is on the cards. The same principle applies to the downside. The price action is trending lower, but is making signs of reversing by printing a higher low. However, the momentum is continuing to make lower lows. And in chapter 12, I will give you the full details of the trading strategy that I utilize when trading reverse divergences. But I want to describe the setup in my own words now, and then we can go into the technical details in chapter 12. My reverse divergence setup essentially involves buying into a market which is already trending higher, i.e. I'm following the trend, or I will be selling short a market which is already falling. Now, how do I decide if a market is trending higher or lower? The simple answer is I use a trend indicator. It doesn't have to be a terribly sophisticated trend indicator. For me, it is enough to use a simple moving average. It shows the average price over a period of time, which I decide. I use the 89 period moving average as my trend indicator. So whether I trade this pattern on a 5-minute chart or a 15-minute chart or even an hourly or 4-hourly chart, I will use the 89 period moving average as my trend signal. What I am looking for is as follows. My trend indicator needs to point in one direction, up or down. If the market is trading sideways, then I stand aside and look elsewhere. Let's face it, there's plenty of currencies to choose from. If the trend indicator is pointing higher, I will be looking to buy the market. The market should be trading above the 89 period moving average as well. Now, I am now waiting for the market price to make a higher low, or what we call a rising low, but at the same time, I am looking for the momentum indicator to make a falling low. This is shown on the chart on your screen now. Here you can see the market trading above the 89 period simple moving average while the oscillator is making falling lows. My goal is to trade in the direction of the prevailing trend, i.e. in the direction of the 89 period moving average. Once I see a setup of this nature, I will wait for the market to give me a clue that it is ready to resume a move in the direction of the prevailing trend. I will be watching for a candle chart pattern to enter the market, or potentially the market coming down to touch an area of support. The opposite holds true for bearish setup. Let's take a practical example from a recent trade I placed in the market. On this 2-hour chart of the euro against the US dollar, you can see how the market is trading below the 89 period moving average. As such, I am looking for opportunities to sell short. On the price chart, the market has gone from being range bound to breaking down, and I'm able to draw a blue line signifying that the market has made a high and a lower high. However, on the momentum indicator, where I use the stochastics for this setup, you can see how it is making a series of rising highs. I have drawn a blue line on the momentum indicator signifying that it is making a rising high. How this should be viewed is as follows. The peak on the price chart corresponds with a peak on the momentum chart. The secondary peak on the price chart, which is lower than the first peak on the price chart, signifies a downtrend, but on the momentum indicator, the corresponding peak is higher than the previous peak. And this is what's known as reverse divergence. The red line you see in the middle of the chart image is my attempt to draw a line where the market will find some resistance. This is not a specific law to drawing a horizontal line like that. It is simply just largely the result of trial and error and years of experience. In this particular trade, I saw the reverse divergence and I knew I wanted to short the market. I went short just around the red line with a stop above the previous peak. My risk in this particular trade was 25 pips. Now, I don't use a fixed stop loss when I trade. Rather, I gauge each potential trade individually, and I assess how much tolerance to give the stop, and I adjust my position size accordingly. Now, I hope this has given you an idea how I trade and how I use momentum together with a simple trend indicator to get me into trades. But as I said before, we will look into this in much greater detail in Chapter 12.